Hi, how are you? This is Phillip Guan, CPAs. Welcome to the classes to teach you how to do tax return. And this is class number 10. So we already taught the past 9 classes. So today we're going to, let me tell you what we are going to learn. I'm going to share screen. So first I'm going to show you so let me share screen. Okay. So now the interesting point is once I get a share screen, the things I share originally pull it up, it doesn't show. So now, so we are in class number 10. Okay. And I am going to share in you should be able to see my screen on both sides, right? Can you see my screen both sides?
Yes, I can.
Okay, good, very good. So now, the learning objective of class number 10, the W-2 income, which is the review. When you work for church, so you have this income. This is something new for today to learn. And this is special allowance. And also Schedule C is a review. So we learn something new in the middle. We review something what we have been learning. So now, the taxpayer is called green bean. Okay. So obvious. Everything in this training, all the name, all the social, all the address information are make-up numbers. They're not real client. They're not. There's no confidential information. As you can see, all the numbers are for training purpose. Okay. So now, in data entry, we put to here. The first thing is a husband and wife, so therefore use number 2. So the left side is taxpayer. Not all the time the husband as a taxpayer. Sometimes the wife as a taxpayer. It's chosen by the clients. Like normally, when you accept the new client, their last year tax return, and you, in the most situation, consistent with the last year because that's where their file in the IRS system is by the first person, which is taxpayer's social. So now, as you can see, I highlight in the left-hand side. This is on the right-hand side, the right side of the screen, the left side. That's where you can input. So now, the spouse information is like here. We are in the right side of the screen. The far right, that's where you're going to get the spouse information. Now, we have a person who actually, a green bean is receiving W-2, right here. The W-2 come from here. So now, in this situation, the W-2 is in right here. The one that I highlighted is for taxpayer. Okay, so first in the right side screen, at the left corner, right here, this belongs to taxpayer, and this fall to now. is the wage pay are from electing churches. So you choose C in there. There's different options. Like here. The previous W2 input, we do not need to make any selection from this special tax treatment. But in this one, yes. So now, box number 1, which is 42,000. Box number 2, which is federal withholding, 4300. Now, the system makes box 3 and 5 equal to box 1. In this situation, they are correct. So now, the original information was not for state of California. I purposely make it to state of California. So I changed the zip code. I want to taught you the state of California tax return. That's where we stay. So I changed it to 94134 for illustration purpose. Now, as you can see in here, the first one, the client information, the employee information, still not California. How to do it? So we're going to, on the top, we purposely change it to the spouse, which is the other one. You click somewhere, it goes, San Francisco has just show up. Now going back to taxpayer, now they stay there. So now, let's say, there's no zip code like that. Okay. Let's say this church is also in San Francisco. This 94133. Okay. I just make it up, these numbers. So now, in this situation, RS, this is a CA. Assuming this person put in 2,000 as the state of California state tax withholding, and also, let's say they put in about this one, California SDI. That's what normal does. So in this situation, this is all you need to do. Now, for this taxpayer, now there are some entry for some other W2 you need to put it, but in this situation, for example, additional entries in here, so then, but it's not applied in this situation. You want to escape to get out from here. So now, there's another W2 which is come from the spouse. It's a nurse. Is from here. Let's say you're working on this. I want to input another W2 for the spouse. How to do it, Connie? Page down. Page up, go to the previous screen. Page down, go to the next input screen for W2. Wherever you input it on, if you go to page down, you're going to create another similar screen. So now in this situation, it's a spouse. And we want to make sure the EIN number is correct. $74,000 and 8015. And the rest of the numbers. I also changed this one. They are in San Francisco, so I do the same thing. And this one belongs to spouse. Like that. So now I also change this one. I hope there's no zip code like that. Let me see, there is. Okay. I am changing both, all of them to in San Francisco for illustration purpose. Now let's say you put in 3,000 for state of California tax, and also put in this. I just make up these numbers. They're not exactly like that. So now we finish the input for 2W2. Double click in here. Okay. There is an health insurance provided, which provide in here. For federal, there's no longer there's a penalty. But for state of California, we go to state of California like there. The third tab, we hit income in there. The fourth tab, we hit the first one, HCM. Very first one, yes, they have health insurance, which provided by the company. So if you have a Cover California, you need to fill this one out. And this one does not have Cover California. It's a company provided. So now we're going to escape. So now in here, we back to the name and address. They do not have foreign asset. Need to report it. They do not have the virtual currency. Need to report it. Now their ID. In this situation, let's say it's like that. The state of California ID start with one letter, right? Depends on what you are, but not CA like that. But it's like A something, B something, F something like that. Okay. Shift Control Space to get rid of more than one. So now we want to get back. Escape. So now let me see if there's any estimate tax. No, here. Here's what they say. They have some refunds. But estimate tax. The estimate tax is paying to $1,000 per quarter. So now the first one. So when you do 2022 tax return, this will be 2022 in here. I am using 2021 tax software to prepare a tax return for the year of tax 2021. Some people ask me, why do we need to pay estimate tax? Well, if you don't pay estimate tax, you are going to get penalized. That's called under payment. So they also say, if there's any extra, we're going to apply for next year. In the right side, far right, like that. And the first option, A, apply overpayment and use up. And that's what here. So now, the first option right here, I can choose up to $1,000. They round up to the $1,000. So now, state of California, let's say, for example, if they would have been pay estimate tax for state of California, let's say $500 per quarter. It's not an example. I just make up these numbers. We also choose state of California. We also, now it's funny, you need to do this. And in your mind, normally say I'm going to stay franchise tax. But actually, in this tax software, you use this one, it's better to get into the right number. So now you round to the 100. So also apply if there's any extra. So now, what is this way? So we done this, we done the health insurance, we done the W2. What else we do? We need to. So now, there is, so in this situation, there's a special 14,400 of his income is not here. You're going to get the allowance, which we need to put that in. Okay. So now in here, in the actual tax return, this is the only one thing you need to input it in. Other than that, they're pretty straightforward. So now, let's view first. Now in the W2, as you can see, there are two W2s. And this is the church. This is the work for the church for this W2. So you double check like what I did, what I'm doing right now. So then you go to second W2, like here. You against the original, you double check. Like this. So you double check so everything is correct. So the W2, they have this. You get this withholding, you get this. So the number, the W2 amount is correct. So now, what else? Okay. So now, is there anything we need to do? Okay. This allowance we have not been put it in yet. So now, okay. In the original, there is one thing. You get this. There's a 2,500. You get it when when somebody get married and then they hire you. So now they get paid. So this is in the Schedule C, like here. 2,500, like that. Now, if there's any related expenses, that could be like say some material, some supplies, if there's any. If there's no, that's it. Okay. Let's say if they need to use any other things for this 2,500, they can deduct it in here. And which is like here. You see it? Okay. So office expenses. And also supplies. The travel. So now, for this Schedule C by itself, it doesn't net a lot. It's only next about $800. So now there is one more. It's dividend. It's $500 dividend. It's also qualified dividend, like here. 5,000. Excuse me. Do they have any? Okay. They do not have any rental in this example. Okay. In this example, they do not have any rental. I have this one is because I use this one to do other examples. Okay. Let me delete this one. So now, at this moment, the dividend is there's a list of dividend you can actually see in here. We can see from here the dividend sheet from here, 8,000. We also can see the dividend. There's ordinary dividend and there's qualified dividend. So in fact, there's only 5,000 dividend. All of them are qualified dividend. They are going to pay less tax on it. Okay. So now, at this situation, now this 5,000 is from the yes. So let me see. I believe qualified in there, and the QBI in here. Delete this one. In this situation, there's none of them. So the QBI will be there's 800 of net income from this Schedule C. So therefore, the QBI will qualify income. Hold on, let me see. Do you have any question for this practice? Is there a question you can ask so I can answer your questions? Now, in this example, there are two W2, there are one dividend, and there are one Schedule C. Okay, there's also the allowance. I'm going to taught you guys how to get the allowance right in here. So now, when you do the adjustment for incomes, okay, now in here there is adjustment to incomes. Okay, now there in here stuff from education, IRA, SEP-IRA, and also self-employment health insurance, IRA in here, student loan, interest, and jury duty. Now, in this, if you go down from here, you do not have the adjustment. So now there is one thing they tells you in here is the rent value of that 14,000 allowance. So now we could do in here PAI. Let me see. Now I think when we don't have a linear, it may not come over. I had to go to the now this one is at no, that's not what we want to do. We want to be a minus, okay? But this does not allow us to go to the negative. So what we're going to do is we go to the income. Under the income, in here, there will be a different adjustment. As you can see in here, let me highlight it. Let me show it to you. So this is for scholarship, and this is not important. This is not what we are looking for, okay? Let's say when you sometimes have some dividend income, let's say the client do not have a 1099, but they show you the statement and you can put it in here. Some people do not receive 1099-R, but they know they're distributed, that you put in here. Those are adjustments. Now, those are additional to income. So now in here, there's some fixed numbers, fixed items, okay? There are fixed items that you can use it for the first 3 in here. But there's a 4th one. So in here, you as you can see, you don't see the options. Now we can do in here. We can do the last one. So now we are going to see this. Okay. Oh. Yes. Here's when you use a. Sometimes when you use U-median, and that's where you can. It's even though we was like there, and now it get me to. This is what I'm supposed to. As you can see, I already have more than one copy in there. So now I am going to go to the last one, the second to the last, now in here. So do this adjustment, see whether or not in allowing to now in here it belongs to taxpayer. You see the negative number in here, and this number show in the schedule 1 in right here as a negative. So this number is going to be offset in here. So at the end of the day, they're going to have less incomes in there. Now, alternatively, they should be an option in a W2. Let me see if there is in here. that we'll be able to make an adjustment. Now, now in here, we do not have any. So do you remember we make that, we already say wait for the elected church. We already make that, okay? So now in here, page down, then we go to that. So now, and then from here, we don't have that. Let me see. It doesn't give us an option in here. So the one that I did it is okay. So we are going to exclude that income. So let's go back to here. As you can see in here in schedule 1, under here there's a negative number. So this negative number, and to go to here. So as you can see in here, they minus. So it's already minus from the total income. So this whole thing, the tax will decreasing, and you get the refund of $1,753. Now, how come they're supposed to be have a refund of this, and how come like this? Because based on this situation, the total estimate tax for the next years only need 4,000. But on the opposite, the last year it was 2,000 each quarter, so it's 8,000. Now, by law, you're required to pay 100% of last year tax or 90% of the current year tax. The current year tax you don't know. So therefore, and this way, you will be okay to avoid a penalty. Now, if you want to play safe, and let's say in case the income is small, so that you could apply all of the refund. So here's what you do. Here's what you do. Right here. You're going to make estimate tax equal to overpayment. By doing this way, what you're doing is you apply all the 5,000 plus as an estimate tax. Like that. So you are not going to get the refund. Instead, you have more applying for the next year. That play a little bit safe. Any question? Any question for me? No question? Okay. I'm going to using this. I'm going to add on the situation that what we have been learned before. Kind of like a little bit review. Okay. So now, from this point on, the things will not be in the left side of the information. That this is that I'm going to add on it. So I'm going to close this one and to enlarge it. So now, assuming they have a kid, okay? Okay, there's a kid. There's a smart kid. Okay. Okay. This kid. Okay. Yeah. Okay. Now 1, 2, 3, 4, 5, 6. Assuming this is a, let's say there's a son. Let's say they have a kid. The birthday is 20. 18, which means we're doing 2021 tax return. They are very young kid, 3 years old. So in this situation, I'm using for state of California. Yes, no. Skip those 2 questions. Yes, yes, yes. They send it to childcare. Live with the home with the kids. So now, and this kid go to childcare at 800 per month. So 800 per month, how much is per year? Well, you double click in here. 800 times 12 equal to this. Like this. This is per year. Childcare. Now, when you have this, you go to 2441. Now, this is a yes. They go to this. Just assume this is an EIN. And this is the amount. Those are all makeup numbers. So now, they send the kid to this XYE daycare. Let's say. So now, harvest. Since they have a kid, they will have a advanced child tax credit, right? Under here, under credit, the right hand side, AA12, they have 1 kid. So they're supposed to be get 3,600, half of it, 1,800. Half of 1,800 to 900. So husband and wife, each 900 for the kid to get child tax credit. So what that really mean? Here's what I mean. And 80. So they have this much income. They're supposed to, for this kid, have 3,600 for the year of 2021. So now, you see in here, it doesn't have the other number pops. So because we have not been finished all the due diligence. They're not going to be qualified earned income credit. Also in here, this kid, now, however, we need to fill this out as well. I'm not going to fill line out for this one. They're supposed to be filled out because there's a Schedule C. Now, in here, you see, after I fill those information out, the child tax credit, the pops, there's 1,800. It's going to show in here. 1040, like that. And you all of a sudden, you see 4,000. Guess where this 4,000 come from? It comes from Schedule 3, Line 15. Schedule 3, 15. Those are good. Those are credit. Coming from 2441, which is they send the kid to go to college, go to daycare. And in the 2021, the special law allow you to take 50% of it. Special law allow you for each kid 8,000, 2 kids together 16,000. So 8,000 per kid, the maximum. This is only good deal for 2021. For 2022, when we file tax return for the client for year 2022, is back to 3,000 and 6,000. And also the percent is not necessarily go to 50%. So that is the 4,000 come from. This 4,000 as a credit is a good deal for the client. The client is get this 4,000. As you can see, as I add this kit back and the tank here, so there's a 1,500 from the child tax credit and 4,000 for the daycare. You see the refund jump. Any question for what I just add for the children? Right here. You need to go to here for right-hand side corner, right here. Do due diligence, and as well as need to go there to choose this kit and fill those information in order to show it. So now, any question for what I just add the child? No. Okay. Now, if they have the rental property, they both join it together and 50-50. Okay, this is their first rental property. It's in Second Main Street. So now, they own a rental property in Second Main Street. I make up those numbers. It's a single family home. Now, this is the very first year they bought the house, and they spend a lot of time to fix it up and do things. And some of them they do handy by themselves, and some of them they hire other people. So they spend more than 250 hours. They also hire other people. They pay $10.99 because they pay them more than $600 and they do it. Now, in this situation, they, let's say, they bought the houses and then do it, remodel for the 1 month, and the first month they did not rent it. They only rent it for the last week. So 11 months since February 1st. So now, in this situation, let's say 4,000 per month. 4,000 per month is 11 months. Now let's say they have put in some advertising because their first time to rent it, and let's say $285. They spend some mileage, and they're doing cleaning and maintenance. Let's say $568 to $69. So now, they ask the agent to look in for the tenant and give a commission for the agent find the tenants. Let's say insurance, let's say they don't have legal and professional fee in this. They do not hire other people to manage it. They're just looking for a tenant, but then they manage it for themselves. There's a mortgage. Let's say the mortgage is $36,525. Now, there's some repair. Let's say 1548. There's some surprise. Let's say 45. Property tax. Let's say the property tax was, in this situation, was 10,000. Now, utility, depreciation, that's where you need to do in here. This is for rental. First one. They bought and put in processes. Now, if they bought it, and also this is what they first put it in. Let's say the building by itself is 500,000. This is 27.5. 27.5. The rent by itself is also 500,000, so it's a 1 million property. Would always like that? No. You're looking for property tax, looking for their ratio, and then get the ratio and times the purchase prices. Now, in this situation, what you're going to get? Now, let's look at this. This will, let me get this view. The depreciation is calculated as this much because it's a 1 million property. The depreciation calculated coming from, there's a schedule, and in here, let's say, so in here, and this rental property, this is income, and this is all expenses. As you can see, there's a negative. There's a negative 28,707. Now, you can you deduct all of them? Depends. Now, there is a form 8582, but this is a total loss. Now, based on your income, and then the software will figure out how much loss you actually can deduct it for this year, which is 21,300. So what is the last of the money goes? Now, well, the last of the money is this. It's going to carry over from the next year. So when you pick up a client who have carryover, you must be input those carryover. Where to input it? Now, not in these cases, but let me show you where to input it. It's like here. Now, in here, as you can see, I want to show it to you. Let me enlarge this. Again, negative 28,000, and we are only deductible for 21,300, as you can see in here. So now, this rental property will give you a huge negative, like there. So your client's tax refund is increased, as you can see in here, because they allow deduct that 21,300. What if their income, W2 income, let's say the nurse income, instead of like that, there is 174,000, let's say. What is going to happen? So their income in this situation, I put the wife's income with 100,000 more, as you can see. So now the W2 income by itself is 216,000. Now, what can happen? Would this 28,000 plus get any deduction? The answer is no, as you can see, the 0 in here. So it show it up in form 8582, passive activity loss limitation. When you verify Johnny, when your ATI more than 150,000, you won't be deducted in that year, but you can carry over. So as you can see, this loss, none of them get deducted in this year, unallowed losses. So this loss is going to carry over. It's going to carry over from to the next year. So when you pick up this client, you for sure need to input those numbers. And those losses, if they, in the year when they have an income, decrease it, they can deduct it, or when they sold the property, they could deduct it as well. Any question? No question. I'm going to conclude today's training. Now, what we learned W2. We learned husband and wife W2. We learned somebody work for church and get specialty allowance. And we learned the qualified dividend, get special tax treatment. And we also learned the Schedule C. And you can minus all the expenses. And you also learn, I add on the Schedule E, which is rental. When the rental, there's a loss. Depends on your total incomes. If your total income is more than 150,000, the loss will consider passive loss activity. And you won't be able to deduct it. Unless you are real estate professional. Now, if you're a real estate professional, which in this situation, like here, this little box in here, but there is a special definition for you to qualify real estate professional. You can just check it, because real estate professional give you the right to deduct the loss. I just checked that real estate professional. Now, even they are having 200-something thousand income, they still can deduct these losses. But they have to be, in fact, qualified. And then today, we don't have time to talk to the detail of qualification of real estate professional. So that way, let me go back to the original. The normal rental is not the real estate professional. Okay. Real estate professional for the income tax purpose is not referring to the common meaning of real estate professional, like, for example, you're a real estate agent, you are showing house and buying house for other people. That is not that definition. But this real estate professional definition is for you spend the X amount of the hour for your business to qualify as a real estate professional, so that you could deduct the loss, even though you're more than 150K. So when we get a chance, I'm going to go more in deep to talk about that. Okay. With that, I would like to say thank you very much for you to participate for today's classes. And tomorrow we're going to continue to talk the classes. This week we're going to finish all the classes. Okay. Thank you very much and have a great evening.
Thank you.
Bye-bye.
Good night.
Good night.